Okay, so let's get started here. Today's session we're going to go over. This is basically part 3 of our options sessions. We've had 2 other options sessions before, and there's been a lot of interest in the Discord group wanting more information and going a little bit deeper into options. So that's going to be kind of the focus today, going a little bit deeper, talking about some things that we haven't talked about, maybe covering a few things that we have, just to reiterate some important things about options. I also had a lot of questions from some people in our Discord group, and I'm going to address some of those questions today as well, just in case you might have the same question, just didn't get an opportunity to ask it. So let's go over the first thing. We're going to go over looking at options volume. It was one of the things I saw some folks that were trading some options that really didn't have a lot of volume. Okay, we're going to talk about the cons associated with that. So we're going to look at the options chain here. Actually, let's look at the options chain. I don't know if it'll let me look at that from last week or not. Maybe, no, it won't. Okay, so, since it's Sunday, we're going to have to look at, next Friday expiration on these Tesla options. But whenever you're going to trade an option, you want to take a look at what the volume is on it. You can see the different volume here, and you're going to notice certain price points are going to have more volume. People are going to like to trade a $900 call, let's say, versus an $895 call or an $860 call. So there's typically going to be a lot more volume in those particular calls. But you can look at that. Just make sure you have your volume column up on your calls or puts, whatever you're looking at, and make sure that you're trading a particular option that has some good liquidity. There's a couple of reasons for that. Number one, it's going to make your spread better, right? The lower the volume, typically the wider the spread, okay? So it's, can be difficult to get filled. If there's not a lot of volume there, just like when you're trading a stock with shares, if there's not a lot of volume, you're typically going to have a higher spread, harder to get in and out, and that's not what we want. We want ease of getting in and ease of getting out, right? So if you look at the different volume here, so like this 8:30 strike this is next Friday expiration for Tesla, and this is an 8:30 strike. Look at the volume on it. 4,000 was traded on Friday. Look at the $900 strike, 15,600 volume on that. So you want to concentrate on those that have higher volume for that liquidity reason. Ease of getting in, getting out, lower spread, that type of thing. So that's first and foremost there. Also, you want to pay attention to the open interest. Okay, so what does open interest mean for those that don't know? So let's take a look at this $900 call here expiring next Friday. So on Friday it had 15,614 volume, so that many contracts were traded on Friday. This open interest, what it means is that still 2,537 contracts are still being held. Okay, so those positions are still being held. It hasn't expired, it hasn't sold, they haven't closed their position, so that many contracts are still being held. Okay, now you can take a look at the open interest with a couple of different things. You can take a look at it for, let's say, a stock that has an upcoming catalyst, right? So you can take a look at the open interest on the options on that particular stock if it has options, and you can kind of see what traders are thinking, right? You can look at the put open interest and the call open interest and what those strike prices are. You can kind of get an idea there of, hey, what are traders thinking? Where are they thinking this is going to go on this particular catalyst, whether it be the DUFA or earnings or whatever. So even if you don't trade options, open interest is a good thing to pay attention to for upcoming catalysts. Okay, so let's talk a little bit about trading weeklies, which I primarily do. I'm typically trading same Friday expiration options, trading weeklies and choosing the strike price. So with that, I had a lot of questions on it. And with that, you want to be careful later on in the week, especially on Friday with same-day expiration options. So you want to be careful not to trade too far out of the money on same-day expiration, okay? Because at any time, it could become, somewhat obvious that it's very unlikely that the stock is going to get to that strike price by the close, right? And the option price could fall very quickly. So typically starting on Thursday, I'll typically trade pretty close to at the money. Let's say Tesla's trading at $900. I might be trading whatever call or put, whichever side we're trading to that day, has good liquidity, good volume, that's, pretty close to that particular, where it's trading at, that strike price. So maybe that might be a 910, it might be a 920, might be the 925, whatever it is. But you want to, the closer you get to expiration, the closer to the money you want to be trading those options. That's very important. And you'll see that, if you're, let's say Tesla's trading at $900 and you want to trade the $1,000 call because it's cheap, right? It's only trading at 20 cents or whatever. And we're 6 hours before option expiration. Well, that call's probably not going to move very much, because the likelihood of it getting to $1,000 in the next 6 hours, if you're trading at $900, is pretty slim. Can you do it as a lotto? Yeah, sure. But most of the time, you're going to make a market donation on things like that. So I guess my point is that the closer you get to expiration, especially on same-day expiration, you want to try and trade a little bit closer to at-the-money options. And just make sure and pick one that has good volume. Okay. And you'll also notice something that I've experienced here lately, especially on Tesla, that the deeper the strike price gets in the money. So let's say that you're trading Tesla that day and it's trading at $900. I'm just going to use $900 as an example. It's trading at $900, and you're looking at the 850 call, right? Well, the deeper you get into the money, the less action there's going to be typically on that particular option. You'll see that it's not going to have a lot of volume. It's not going to have, there's going to be a bigger spread because people are looking to, maybe play a little bit out of the money or an at the money call because it's going to typically move a little bit better. Okay. So keep that in mind as well. Some of the best times to play these weeklies are on Monday, Tuesday, and Wednesday. The earlier in the week, obviously, the better. And then you can, on Monday and Tuesday and Wednesday even, oftentimes, you can play, way out of the money options, whether they be call or puts, and they move pretty well. But once you get closer to that expiration, that's when you want to be more careful. Okay, so some of the questions that I had from some folks in the group that I want to address is, number one, the question is do you have to exercise the option? The answer is no. So when you purchase an option, whether it be a call or put, it gives you the right to exercise that option, but not the obligation. So you can absolutely just let it expire, and you never have to buy or sell those shares that you purchase the option for. The second question that I had which was a pretty good question, is does the stock need to hit your strike price in order for you to make profit? Well, the answer is no. So let me give you an example. Basically, you're trading for the difference in premium that you paid for that particular option, right? So, for example, let's take Tesla again, that is currently trading at $900, and let's say you purchase a call with a $950 strike price, okay? And a couple hours later, Tesla's trading at $925. It hasn't hit the $950, it hasn't hit your strike price, but you bought Tesla. You bought a $950 strike price when it was trading at $900. So guess what? Now that it's trading at $925, that $900 call is going to be worth more in premium. We're talking about a day trade here. It's going to be worth more in premium than it was $25 ago, right? It just makes sense. So don't let that scare you away. Whenever you purchase an option, let's say a call at a strike price that's $50 above where it's trading now, it does not have to hit that strike price in order for you to make profit. That was a misconception, I guess, that some of the folks in our group had, and that's simply not the case. So basically, you're just trading the difference in premium. So obviously, your call is going to have some profit due to the increase in premium, even though it actually didn't hit the strike price. And the reason for this is because now the chance of it hitting that 950 strike price is greater than it was, a few hours ago when it was trading at $900, right? Hope that makes sense. Okay, another question that I had was, why trade an option instead of just buying shares, right? Well, let me give you a couple of examples here. Okay, so it's a great question, right? And something that people that are beginning to kind of explore options don't really understand. So let's clarify that. So basically, it gives you more leverage on your investment. So let's take that same example of Tesla trading at $900, okay? You buy one call with a $900 strike price, right? So you buy an at-the-money strike or at-the-money call. So let's say that that particular call is trading at $16. So you would pay $1,600 for one call to have control over 100 shares of Tesla looking for upside, right? Because you bought a call. So to control the same 100 shares of Tesla by buying shares, it cost you 90 grand, right? So there's your difference. There's that leverage. It doesn't make sense on every stock, but for traders looking to leverage their money, it could be something that that they want to take a look at. Some stocks don't have a lot of option liquidity, like we talked about earlier, which definitely needs to be taken into consideration as well. So just because you look at a particular stock and you say, man, I know that this particular stock is going to go up over the next however many days or weeks or whatever, it doesn't necessarily mean that it's going to be a good options trade. I'll show you an example here on Atomera. So let's take a look at Atomera's options. I didn't want to do that. Okay, so Atomera's options. So take a look at Atomera here. So this is from Friday. Their total calls on Friday were 538. Their total puts were 117 for a total of 655 contracts traded on Friday. Versus Tesla on Friday had 955,000 calls, 849,000 puts, for a total of 1.8 million contracts traded on Friday. Okay, so you can see the difference in the liquidity there. That it's going to be much easier to get in and out. Your spread's going to be tighter, and just going to be a much better opportunity, in my opinion. SPY, same thing. SPY's going to be even bigger than Tesla, I'm sure. So SPY, 3.5 million calls on Friday, 4.7 million puts, 8.2 million contracts traded total on Friday. So, those are all things that you want to take a look at when you're considering trading options. Just because you think a particular stock is going to go up doesn't always mean that options are going to be the better way to go versus shares. You want to weigh those different things. Look at the options liquidity. Sometimes shares are the better way to go, right? Okay, so let's take a look at Tesla. Another reason that it's good to take a look at options versus shares is, let me show you Tesla on Friday, this particular put. I traded this put on Friday. I left a lot of money on the table. But let's take a look at this put. So the low on Friday at 9:15 in the morning. Keep in mind I'm Central Time, so that's actually 10:15 market time. But at 10:15 market time, this had a low of 216, okay? And let's see where it ended up closing for the day, or the high of the day was, well, it was at close basically, was $30. So what is that, like a 1,200% move, right? So let's do the math on that. So let's say that you bought one contract. Let's say you got lucky and you were able to pick close to the bottom. and you bought that one contract at $3. Okay, so it cost you $300 to have control of those 100 shares, right? Well, if you wanted control of 100 shares of Tesla, just on the share side, well, you couldn't even buy one share for $300, right? At the time, Tesla was trading around, it was over 900 bucks. I just know because I took the trade a little bit after that. But it was trading, I think, at $928. So to buy one share, it would have cost, well, actually you would have shorted one share. It would have cost 928 bucks. So it would have been over 3 times your investment, right? And what would you have made? I did the math on it earlier for our session today, and if you shorted one share at 3 times your investment, what you would put into the put, right? It would have made you 60 bucks, okay? Whereas if you bought one put contract at $300, trading at $3, and let's say you got lucky and you rode it all the way to 30 bucks, we're just doing it for easy math there. I mean, you just took a $300 investment and, you made 2,700 bucks on it, right? Because you could have sold it at $30 if you caught the high. Obviously, very difficult to do that, but you can see where I'm going. There is a lot, or there can be a lot more opportunity in the options play than there is with the shares play, with a less amount of investment out of your account. All right, so basically, my point is that, even though the underlying stock, let's say Tesla, for example, may only move 2% or 2.5% or whatever it is throughout a given day, that an option can move many hundreds of percent, right? Which, is obviously a better multiplier on your profit. Okay, another question that I had was, do I do my technical analysis and my charting off of the options chart? This is a chart of the actual $900 put closing last Friday. Would I do my technical analysis and charting off of the options chart, or do I do it off of the underlying stock chart? Well, what I do is I do it off of the underlying stock chart. I don't really know of anyone that does it off of the options chart. Maybe there are some people that do, but when I'm basically trading these options, I'm doing it off of the underlying because the underlying is going to dictate where the option goes, right? The options chart is going to follow what the underlying is doing, not the other way around, right? So I'm typically watching the underlying. There are certain stocks, Tesla's definitely one of them, along with, some of the other bigger stocks, Nvidia and Apple and all those other guys, barring any news that they had for the day, they're going to mostly kind of follow the overall market, right? So I think it's very important, and I do this, so I watch SPY at the same time. You can watch SPY, you can watch the S&P E-mini futures, whichever one you want. So I'm watching that at the same time. So like I said before, I'm watching 5 charts at one time. This is one chart that I'm watching because this is where I'm doing my buying and selling on the ladder over here, on the actual option itself. And then on a separate monitor, I have 4 charts up. I'm watching SPY with 2 SPY charts up with different time frames and a couple different indicators. Same with Tesla. I have 2 Tesla charts up with different time frames and a couple different indicators as well. Actually taking the trade on this particular chart here. So that's going to kind of cover what I wanted to go over. What I wanted to do now is, since we've had so many questions on the options, I wanted to open it up for questions for you guys to hit me with so that we can get those answered and go forward with that. So I'm going to stop the recording now.